Hello everyone, I'm Shekhar from Momentum Labs. Now in this video, I'll be showing you guys how do you backtest a dual momentum strategy. Now I've already done a absolute momentum strategy backtest, so you can go through that video. The link is available in the description. Now in this video, I'm going to do a dual momentum strategy using Google Sheets again. I'm not a SEBI advisor. The objective of doing this video is not to give any investment advice or tips, but to share you the logic of backtesting and also to expose you to different momentum strategies. And it is purely for education and knowledge sharing purpose. Now let me begin this video. So I've divided this video into three parts. The first part, I'll show you the results first. I'll show you the results and compare it with the benchmarks so that you get a feel of this strategy and see how is it superior compared to the benchmarks. Now, once you see the results, then I'm going to show you the logic for this strategy. You understand the logic in simple English terms. And I'll also show you how to convert this logic into a mathematical expression or form in Google Sheets. So that is going to be the third part. The third part is purely going to be on Google Sheets, where I'll be transforming this logic into the Google Sheets and getting out the data and finally coming up with the results. So anyone who's interested in only the uh, calculation of this backtesting model, so they can directly jump to the third part. If someone is interested only in the seeing the results and understanding what the logic is, they can just see the first and second part. So let me begin first by sharing the results. So let's begin with the analysis. Now in this graph, you can see that there are three plots. One of the strategy, which is marked in blue color. And then we have Nifty in red color. And then we have gold in gold color. So one thing that definitely comes out is that the blue colored line or the strategy is outperforming both the benchmarks, Nifty and gold, by a wide margin. And the outperformance, if you see, has started to happen from the 2020 time onwards, or especially from the COVID times. Now, 100 rupees invested in the year 2014 is now equal to 500 in case of strategy. Whereas 100 rupees invested in either Nifty or gold, they are somewhere in between 300 and 250. So you can see that the outperformance is almost twice as of the nearest benchmarks. Now I've taken 10 years of data for this backtesting analysis. Now you must be wondering what is the composition or what are the stocks that I'm taking into consideration for this blue colored strategy. So it is very simple. I'm not taking any new stocks or new assets for this strategy. The composition of this blue colored line is nothing but the same Nifty and gold. But I'm using a logic or a mechanism which will tell me when to invest in each of them at an appropriate time. So let's see the results in returns terms. You can get an understanding of the strategy. So you see that the overall strategy has performed in the absolute terms by 382%, whereas Nifty gave 184 and gold gave 156. And if you see in terms of CAGR, the strategy gave around 18.5%, whereas Nifty gave 12% and gold around 11%. Now, the advantage of this strategy is that it also has lesser drawdowns. You can see that the max drawdown of the strategy is around 11.26%, whereas Nifty had minus 34% and gold had minus 22%. So the strategy is better on both the return terms as well as on the drawdown terms as well. Now let's calculate the ROMAD ratio, which is nothing but the max or the returns divided by the max drawdown. That gives the an understanding of what is the risk to reward that we're taking. So on the risk to reward also, this performs really well. Now, the another advantage of this strategy is that it is robust across time frames. So I've calculated 1 year, 3 year, and 5 year rolling returns. So let's say you come and invest at a random point of time during this 10-year time frame, and you let's say stay for 3 years. Now, the average 3 year rolling returns would be around 21.82% compared with 14.15 with Nifty and 10.34 with gold. So the rolling returns are also superior. Now, on these 3 points, that is returns, risk, and robustness of the strategy, the dual momentum strategy scores well above Nifty and gold benchmark indices. Now, we have understood that the results are superior. Let's go ahead and check what is the logic for this strategy. Well, let's define the logic for dual momentum strategy. As the name dual momentum suggests, it is a combination of two momentum strategies, one absolute and second relative. Let me explain both in detail. Absolute momentum suggests that any given stock or an asset should be performing over a period of time. And we are not taking into consideration any other assets. We are just checking the asset or a stock against its own performance in the historical context. So, in other words, it means that a stock or an asset should be in an uptrend. Now, how do you define an uptrend? You could plot its moving averages and say if the closing price is above moving average, you say that it is an uptrend. Or one other way could be that if, let's say, last X days of return is greater than 0%, meaning that it has given some positive returns, that is also a definition of an uptrend. Or you can also say that, let's say, last X days of return is greater than the inflation rate. That is also another way of expressing an absolute momentum. So in this case, what I've done is the absolute momentum I've defined as saying if Nifty has beaten in the last 200 days, at least the FT returns of 200 days. Assuming that in the last 200 days, whatever FT returns were there, for example, let's take it as 3%. And if Nifty has beaten or Nifty has given more than 3% of returns in the last 200 days, then the absolute momentum criteria has been met. If the absolute momentum criteria has not been met, that is, if the Nifty returns over the last 200 days are not even greater than FT, then we just go ahead and invest in FDs. Now, assuming that the absolute momentum criteria is met, then we have another logic to check that is, did Nifty beat gold in the last 200 days in terms of returns? So first we have checked whether the Nifty is beating the FD returns or not. And now we are checking whether Nifty has overperformed gold or not. If Nifty indeed overperformed gold the last 200 days in terms of returns, then we go ahead and invest in Nifty. If Nifty did not perform or did not overperform gold in the last 200 days, then we just go ahead and invest in gold. That's the simple logic. So seemingly simple strategies actually give much better superior results than complex strategies. So this is it. That's it. You can, if you want, I can quickly recap also. So we first check Nifty returns and compare it with FD for the last 200 days. If it is no, we go ahead and invest in FD. If it is yes, again we do a check of Nifty returns with gold returns for the last 200 days. If Nifty has given better returns than gold, then we go ahead and invest in Nifty. If Nifty did not give better the returns than gold, we go ahead and invest in gold. Now, that is the strategy. What we do is we rebalance it at every week. I'll show you how to backtest a dual momentum strategy on Google Sheets. So there are 4 parts to backtesting. One, you get the raw data. Second, you build the strategy using the signal. And third, you compare it with the benchmark. And finally, 4, you get the results to interpret. Now, first, let's get the raw data. So to get the raw data, I'll use the Google Finance function. Now, you can use the Google Finance function to get last 10 years data. What I'll do is I'll quickly show you a sample of the query so that you understand. First, you say you equal to Google Finance, you enter the ticker since it is Nifty Bees. So I'm going to call it as Nifty Bees, comma, you give the attribute. The attribute here is the price. So automatically the price that you get is nothing but the closing price of that ticker, and you give the start date. So since I'm going to take 10 years old data, right? So what I'm going to do is I'll say today minus 3650. So which means I'm taking data from 10 years in the history till today. And you say the interval. I'm going to take a weekly time frame because daily will be too much to handle. So let me take weekly time frame. So that's how you get the data. So you change this Nifty Bs to Gold Bs to get Gold Bs data. Now, once you get the raw data, you copy paste it in the main sheet. So that's what I did here. You see this two columns date, A and B. This is for Nifty, since 23 May 2014 till 10th May 2024. Same thing I did for gold closing price. Now, once you get the closing price of Nifty and gold, the second thing that I did was to get the weekly returns. Now, how do you calculate weekly returns? Pretty simple. It is equal to B6 by B5 minus 1, nothing but the current week's close divided by the previous week's close minus 1. And you change the format to percentage so that you get in terms of percent, and you do a double click or you drag it. So you get weekly returns for Nifty as well as gold. The other thing that you need is to define what is the benchmark for absolute momentum returns. Now, in this case, if you might have seen that, I told that if Nifty beats the FT returns in the last 200 days, then we go ahead and check with gold, right? Now, to do this comparison with Nifty and FT returns, we need a benchmark. So for that, simplicity, I took 3%. So this number might be different also now. Now it is in fact higher, but assuming that on the conservative side, that on a 200 day, in 200 days, the risk-free rate that you could get by either investing in government securities or FD is 3%. That is what I've ensured here. Now what I'm going to do is, I'm going to compare the 200 days return of Nifty with this 3%. So to get the 200-day return, now what we need to do is, we need to compare these 3% returns of FDs with Nifty B's 200-day return. Now to get the Nifty B's 200-day return, let's start from 1st of April. So what I'm going to do is, I am dividing B49 divided by B21 minus 1. The reason for choosing B21 is because we'll get exactly 200 days return. So let me quickly show you. So I'll subtract A49 minus A21. So you get 201 days. So I was assuming it roughly to be 200. So that's the difference. B49 by B21 minus 1. Now I'll drag this all the way down so that I'll get the 200-day returns for every week. So if you were to interpret this 5.11%, what it means is that as on end of 1st April 2015, the closing price of Nifty Bs was 86.06. Over the last 1 week, it gave a return of 2.51%. And over the last 200 days, it has given a return of 5.11%. The same thing we'll do for gold Bs as well. You can check the formula, F49 divided by F21 minus 1. This gives the 200-day return of gold Bs. It is either 200-day return or 40-week return, both the same. Okay. Now that we've got 200-day return for both Nifty Bs and gold Bs, let's go ahead and do this comparison using this logic. Now the logic here is, if Nifty is greater than gold and if Nifty is greater than FD, invest in Nifty. Similarly, if gold is greater than Nifty and is gold is greater than FD, invest in gold. If neither Nifty nor gold is greater than FD, then invest in FD. So those are the three signals that we need to get and invest. So we'll go back to the Google Sheet and check create a new if rule to get this logic. Now I'm using another column called position in this column. The logic that I'm going to write is equal to if and basically means I'm validating two conditions here simultaneously. One, D49 greater than H49, which is the Nifty 200 days return should be greater than gold 200-day return, comma, D49 greater than C3. I am fixing C3 here. C3 here nothing but is the 200 days fixed deposit return. Now, if both the conditions are met, only then call it as 1 or else 0. So as you can see, it is a 1 because 5.11% is greater than 3% is greater than minus 3.44%, and hence this is a 1. If Nifty B is less in any of the conditions, that is either Nifty B's returns are less than gold or less than the fixed deposit returns, then it will return a 0 value here. Same thing happens with gold. In gold case, gold should beat G3. G3 also same number of foot, 3%. Or and gold should also beat Nifty B returns of 200 days. If both are met, then 1 or 0. As you can see, there's a complementarity between Nifty position and gold position. If Nifty is true, then gold is false. If gold is true, Nifty is false. There can be a third condition, that is both Nifty can be 0 and gold can be 0. When does that happen? When both Nifty and gold are unable to satisfy this condition, which is they're unable to beat the FD returns. In that case, and only in that case, both gold and Nifty will give a value of 0, 0. So if, for example, you see this row on 15th of May 2015, both Nifty gave a signal of 0, gold also gave a signal of 0. Let's see the reason. The Nifty returns as on 15th May, 200-day returns are 2.81%, which is less than 3%. And automatically in the if condition, if any of it is not being met, it becomes 0. So even if we don't have to even check for whether Nifty bet gold or not, since automatically Nifty was not able to beat the FD returns, this will turn a 0. Now let's check the case of gold. Now gold also, the 200-day returns are minus 0.75%, which is worse than the Nifty returns and also less than the fixed deposit returns. So automatically this also will give a value of 0. So to quickly recap, let me write down the strategy here. So if it is gold, then we'll get a signal of 1, 0. As in gold should trigger a 1 and Nifty should trigger a 0. Now to get a Nifty, the gold should trigger a 0, Nifty should trigger a 1. Now to get an FD signal, both should trigger 0, 0. There is no condition of 1 and 1, meaning one of it should definitely be better than the other. Now that we have got signal, so the next step is to build the equity curve. Equity curve is nothing but this beautiful graph of the in blue color line. Now to build the equity curve, the first thing that we need is to set a base. Now I'm choosing a base of 100. The second thing is, since we've already got signals, right? Second thing is to multiply the base with the weekly returns of the strategy. Now, how do we get weekly returns of the strategy? Now, there are two parts. One, you can get your weekly returns by investing in one of the asset. So let's say if the signal gives Nifty, then we invest in Nifty. Or if the signal gives invest in gold, we invest in gold. So these are both complementary. Now, since these both are complementary, now what I'm going to do is I'm going to calculate a weekly return of Nifty plus gold, which is nothing but equal to sum product of the position of gold multiplied by 200-day, multiplied by the weekly return of gold plus the position of Nifty multiplied by the weekly return of Nifty. Now, since either of it is always a 0, we'll always get a weekly return of the position where either Nifty is available or gold is available. Now, there is one drawback here. We'll not get the weekly returns of the strategy when both are 0. That is, in the case where both Nifty and gold is 0. In that case, we're ideally investing in FD, right? Now, how do we add the FD returns to the weekly return of the Nifty plus gold? So we write down one more column. Now, the column formula is very simple. What we do is equal to we summate the positions of gold plus Nifty and subtract it with -1. Now, why we're doing this way is, in the case where either of it is 1, automatically this value will come out to be 0, because 1 plus 0 or 0 plus 1 minus 1 will always be 0. The only case this will get triggered is when the gold as well as Nifty, both these positions are 0. Only then 0 plus 0 minus 1. So this will get triggered as -1. And what we'll do is we'll multiply with the weekly return of the FD. Now this 3%, remember, is a 200-day return. To get one weekly return, we'll need to divide this 3% into 1 week unit. So for that, what I'm going to do is I'm going to divide this 3% divide by 40. If I divide by 40, I'll get 1 week return of the FD. Now, since the signal generated a -1, I need to multiply it with minus to convert it into a positive return. So whenever you see that there is a signal of 0 in Nifty and 0 in gold, you always see that the weekly return of FD is 0.08%. Now, these both are mutually exclusive in nature, because as you can see, this branch is separate from this branch. If this branch gets activated, then this branch is never activated. If this branch is activated, then this branch never gets activated. So, and hence we can easily sum these two weekly returns to get the final weekly return of this strategy. So pay attention again. This is very important to calculate the weekly returns of the strategy. We need to create first weekly returns of the gold, which is nothing but a sum product of the position of gold multiplied by weekly return of gold plus the position of Nifty multiplied by the weekly return of Nifty. Since these both are complementary in nature, we'll only get the weekly return of the strategy or the position that we are holding. Now, in this case, since we're holding Nifty Bs for 10th of April, so only the weekly returns of Nifty Bs for this week is generated here. Now, this weekly returns of FD will get activated only in the case where both gold as well as Nifty give a return of 0. In this case, we'll get a weekly return of 0.08%. Now, if you get a weekly return of 0.08%, ideally we should be adding this to our strategies returns also, right? So that's what we're going to do in the final column, which is total weekly return of the strategy, which is nothing but summation of this number plus this number. Now we are finally one step closer to the equity curve. We have got the weekly returns of the strategy from the start till the end. Now the next step that we need to do is we need to multiply the weekly returns of the strategy with the base number to build the equity curve. So you can see that with the yesterday's base price, assuming that based on the yesterday end of the day closing price, we invest today early in the morning, and we get the weekly returns for this entire week, and hence we multiply by this 2.23%, which is nothing but the weekly returns of the strategy for this week. Then we get the NAV for the next week, that is 102.2. And you click on this, double click on this or drag it, you will get the equity curve for the Nifty. Sorry, equity curve for the dual momentum strategy. So that is how this blue color line is represented. Now what I'll do is I'll calculate the rest of the important matrices like maximum drawdown and rolling returns. Now to calculate maximum drawdown, I'll take the help of this graph to understand, make you understand what is a drawdown. A drawdown is nothing but the distance from a previous peak to its current trough. Now, if you see in this equity curve, there are numerous such instances of peaks and troughs being formed. Now, what essentially we are interested specifically is the maximum length in which a peak to trough distance has been formed. Now that we term it as max drawdown. Now how max drawdown will help us? It basically gives us a sense of what is the maximum pain that we have to endure to follow this strategy. Now maximum pain to endure will be different for different people. And for someone, a 10% drawdown might be too scary. For someone else, a 40% drawdown might be scary, and 10% might look a very small number. So it is all subjective. So this max drawdown will basically give a context to anyone who's interested in investing in a strategy, to see that what is it that they can expect if they follow that strategy. Now, to do that, we'll have to first calculate max of every value at the end of every week for the NAV to get this max function. And from the max function, then what I do is I subtract the distance from the max value as of now with the current value. So that will give me the difference. And this difference is nothing but the drawdown. Now, what I do at the end of this is I calculate the minimum value among all such drawdowns. If you see, this entire column is of drawdowns. Now, what I'm doing is I'm calculating, or I'm identifying the minimum of all such values. Basically, that gives me the maximum pain. So for this strategy, the minimum or the maximum drawdown it underwent is only 11.42. When you compare that with Nifty or gold, Nifty is at minus 34, whereas gold is minus 21. Now, if you take a moment and try to understand why is it happening like this, like why are we getting such extraordinary returns and very less drawdowns with two uh, indices like Nifty and Gold, which by it themselves are not that great. Like they are yielding a return of 12% CAGR on average with a max drawdown of minus 34, whereas gold is yielding similar to like 11% returns CAGR on an average and having a minus 21% drawdown. What is it that making special when we combine these two, that the strategy is outperforming these two by miles? So to do that, let's visually inspect the equity curve once. Now let's take some instances where we see that there has been a difference in performances between Nifty and Gold. I'll give you an example. Let's take from 2019 onwards, or even in fact, 2019 onwards. If you see, the gold was an uptrend till 2021, whereas Nifty was flat in the entire 2019, and also it crashed during the COVID times. Even during the COVID times, when the Nifty was crashing, the gold was rising. Now, because of the combination of these two, since we pick whichever is the best one, that is gold during these times, our strategy was outperforming. Now, once gold started to uh, underperform and Nifty started to perform, our strategy will again pick the outperformer, which in this case is Nifty. And hence the outperformance again continues. So it is like you're taking the best of the both worlds, one at a time. And because of this dispersion of mean between Nifty and gold, this proper jugalbandi is happening between these two, and ensuring that we are always staying ahead of both of them. So the next part is to calculate the rolling returns. Rolling returns are pretty easy. So what we do is we take the 1 year returns for every day starting from the last record. Let's say the last record is 10th May 2024. Now for a strategy, the value was 482.3. Now what I do is I calculate what was the NAV exactly 1 year back. So I'll do minus 365 number of records or number of days from this value and calculate what is the percentage. For example, this is the 1 year percentage. If I calculate the 10th May 2024 value divided by M468. M468 is 5th May 2023. So exactly from 1 year, in 1 year, this strategy yielded 20.47% returns. Now for every day, I'll do the same thing. I'll just drag this up and I'll get the 1 year rolling returns for each day during this entire course of time. Now what I'll do is I'll calculate the average of 1 year returns, of average of all such 1 year returns that were possible. That gives me the 1 year rolling return. Now this 1 year rolling return is a better metric to understand than the CAGR. In fact, even if it is even longer, like 3 year or 5 year rolling return, that is even better. So ideally, you should take a look at 3 year and 5 year rolling returns to understand the true performance of any given strategy. Again, on these counts also, the strategy beats Nifty and gold handsomely. Now we have calculated the, we've got the raw data first. Second, we have calculated the signal. Third, we have calculated the strategy's NAV equity curve. And fourthly, we have calculated the benchmarks NAV as well as their equity curve. And we also did calculate the maximum drawdown as well as rolling returns for the strategy and equity curve. We have summarized all these matrices. This completes the entire backtesting process. Now, in this entire backtesting, the main thing that you need to understand is that a backtesting doesn't give any predictability power in the future. It only tells us whether a given strategy or any idea has some merit or not. Now we find that there is some merit in exploring dual momentum strategy. Now, if you want to do, or if you want to explore even more variations of dual momentum strategies, I think you're free to explore. That will give you very good insight. Maybe you can explore by varying the indices. I took Nifty plus gold. Maybe you can take Nifty next 50 plus gold, or you can take instead of 200-day moving 200-day returns, you could only take 100-day returns. You can replace the FD rate of 3% with 2%. So there are a lot of variations that you could explore and play around and form your own hypothesis or strategy. Yeah, that's it from my side in this video. I'll make another backtesting video shortly that is on multi-asset strategy. Like what if you include not only Nifty and Gold, but also other indices like NASDAQ 100 or Hang Seng Bs, or maybe Nifty next 50. Yeah, so we'll see how this combination of multi assets perform and to see the results again. Thank you guys. Have a nice day. Bye.